Hi everyone, Thomas here. Today we're going to take a look at a stock that I think represents an interesting value under current market conditions. It's a company that has a dominant position in the defense and aerospace industry, and that's called RTX Corporation. You may recognize the name as Raytheon. Let's go ahead and dive straight in. This chart shows the stock's trend for most of the past 3 years. After the early stages of the pandemic, the stock saw a pretty significant rally from a low at about $45 per share to an early 2022 high at about $105. Since then, the stock has struggled to find the same kind of momentum, and in fact, over the last few months, has picked up a lot of bearish momentum, dropping from a peak at around $102 in the first quarter of the year to a low just a few weeks ago at around $70. That means that the stock has dropped a little over 30% from those highs above $100 per share. That, from a technical standpoint alone, should start to bring up the question of whether or not the stock has dropped far enough to represent a possible reversal point, given that it's well in its own bear market territory. Also, it is interesting that over those past few weeks, the stock has been picking up bullish momentum that now has it pushing up to about $84 per share. The stock is right now very near to its most immediate resistance, which is from the 200-week moving average, which is right at around $84 per share. Considering the fact that over the last 2 weeks the stock has failed to push above that point, that could mean that it is poised to reverse and possibly drop back down to revisit those yearly lows at around $70 per share. At the same time, it could also simply be taking a pause from the rally that we saw in the last 3 weeks. It saw it rally from about 72 up to about $84 and could be looking for an opportunity to catch its breath and continue the rally and reverse the overall downward trend that we've seen throughout this year. That's interesting from a technical standpoint, and it looks like there could be some interesting opportunities for some short-term trades if you're looking for them. The real question is about the company's fundamentals. Are those holding up in a way under current market conditions, rising interest rates, geopolitical tensions, all the rest of it, that it might also represent a good value? Is the rally that we're seeing being driven mostly by sentiment, or are there some indications of strength in the company's business that could suggest that the stock should be worth more than it is today? Let's dive into the fundamentals and let's try to find out. It's interesting to take a note of RTX's free cash flow over the last year. From almost $4.9 billion a year ago, the stock saw its free cash flow drop steadily down to about $2.8 billion 2 quarters ago. From that point, in the most recent quarter, however, the company reported a significant improvement in free cash flow to $5.3 billion per share. That's not quite a 100% reversal from the quarter prior, but it is still very, very interesting and very useful and a sign of some fundamental strength that could lend more credence to the idea that the stock could be offering a good value right now. The company's liquidity has been pretty stable over the past couple of quarters at a little bit under 5.5. It is lower than it was a year ago at 6.2 billion. So we do see a declining pattern of liquidity over that time period. At the same time, long-term debt has also increased. We have 32.7 billion as of the most recent quarter compared to 30.7 billion about a year ago. And so that is a generally negative pattern, especially compared to the way that the company's liquidity has decreased. Some of those indications can also be seen in the company's operating margins. Over the last 12 months, net income was a little under 5%. This is a company that generally operates with fairly narrow operating margins, like a lot of companies in the defense and aerospace sector. The concern is that in the last quarter, that number dropped to negative 7.3%. That confirms some of the negative trends that we're seeing in long-term debt and liquidity. However, the increase in free cash flow is an interesting counterpoint that suggests that some of these elements may simply be temporary phenomenon as coming from things like increasing interest rates. The reason I believe that some of these are temporary phenomenon does come from the current political climate. Management in their earnings reports over the last few quarters have cited things like the war between Ukraine and Russia, and more recently the conflict in Gaza. As tragic as both of those are, as things that will act as tailwinds for their businesses as they are actively working to support America's allies, and military spending in general is increasing. No matter what your opinion on the political side of these questions are, these are elements that I would expect to work in the favor of this particular company. The stock's current price is around $82 per share, a little bit above that. And this is a company that pays a useful dividend of about $2.36 per share. That equates to a yield of about 2.87%. That's not super high, but it is still useful and certainly more than enough to make this a stock that's worth paying attention to as a dividend-paying stock. More interesting, however, is the fact that even with the stock's rally over the last few weeks, the stock's value proposition looks very, very, very compelling. My combination of price to book and price to free cash flow ratios show that a fair value target for the stock should be at around $120 per share, a little above that. With the stock now at around $82 per share, that means that there is about 46, almost 47% of upside from the stock's current price. The next question to ask, whether you're considering RTX as a potential long-term investing opportunity, or whether you're thinking about trying to use the latest technical indicators to consider a trade on a short-term basis, should be trying to think about reward to risk. So let's go back to our chart and let's try to analyze what the stock looks like on that basis. As I mentioned, I have current resistance for the stock at around $84 per share. That is based primarily on the fact that the stock's 200-week moving average is sitting right around that level right now. We have major support for the stock all the way back at the last pivot low that appeared a couple of months ago at around $70 per share. If the stock can break above its current resistance level, then $84 should begin to act as a new support level. And the question in that case then becomes where the stock's next level of resistance would likely be. I like to try to pay attention to prior pivot highs and prior pivot lows for this kind of analysis. If we look back at this pivot high all the way back in 2020, we can actually connect a number of lines here, including a pivot low at the beginning of this year, to put next resistance at about $92. That means that if the stock's current upward momentum continues and it manages to push above 84, break above this level, then it should find next resistance at around $92, about $10 away from the stock's current price. If I were considering placing a short-term trade on RTX right now, they mean that reward to risk for this stock is about $10 of upside from the stock's current price compared to about $12 of downside. So from a technical standpoint, that means that this is probably not a good time to be looking for a short-term trade. Now, on a longer-term basis, if we think about this from a valuation standpoint, if we already believe that it is a good value, then the next question is really what is the overall upside? If I still have this current support at $70 and I do buy it on the basis of a long-term investment, where do I think the top of the market is going to be? Well, the easy answer is to go and look at the most recent highs. And for that, we can go all the way back to 2022. We can see peaks at around $104. That target at around $104 really says nothing about the fair value target that my analysis has at around $126 per share. So if we think about it on that basis, that means that from about $82 per share, there's $44 of upside against $12 down, which is more than a 3-to-1 reward to risk ratio on a valuation basis. What does all of this mean? Well, again, as I mentioned, if I were looking for a short-term trade on RTX, I'd probably pass for now. But since this is ultimately about trying to identify whether or not the stock represents a good value right now, the obvious answer has to be that RTX is a big bargain right now, one that you should probably begin to think about. Thanks for your time, everybody. I hope this has been useful. If you like this video, please go ahead and subscribe to my channel by clicking right here. If you're interested in learning more about my investing system, you can click on this video to learn more. If you'd like to subscribe to my trading alerts, you can also click on the link in the description field below. I'm Thomas at Rebel Income. Talk to you again soon.